Dear viewers, Assalamu alaikum. Today we will learn a very interesting topic. But before this, I'm Mal Farmer from AM Consultancy and Service. Today our topic is finance cost. What is finance cost? Finance cost means the cost we incur due to borrowing a loan from a bank or from other sources. It means the interest cost, uh, other charges, all will cover the finance cost to use the fund or to use the capital. Our topic today is finance cost estimate for working capital management for a company in the US, a sample company, a hypothetical company. Why we need to know about this? Actually, it's detailed. It's a detailed. You'll hardly find any such a video. Today in this video, we'll detail about finance cost. It has some implications and some insights. Whenever we run a business, run an operation, we have a great many current expenses or running expenses. To pay those expenses, we have to secure some fund. The fund comes from the owner or the fund comes from the bank. If it comes from the owner, then we have to pay the owner its profit or margin. If it comes from the bank, we have to pay interest because we're using his fund or he's using his fund. But the fund we bring from the bank, we can transfer as our capital. Okay, that's why we will detail today what is working capital management. But before this one, we need a hypothetical company. For our simplicity, I would like to detail suppose we have a company, the name of our company is XYZ. Business type, suppose we have a manufacturing and distribution business. And we are calculating this finance cost in the year 2025, and definitely our currency is USD. Now we are going to calculate our working capital requirement actually. What is working capital requirement? Everybody will say current asset minus current liability. There is no net working capital. It is also true. But actually, this means to run day-to-day operation, to run day-to-day business throughout the year, how much fund we required. Today we are going to calculate this one. Okay, let's check. Currently, our current asset is cash and bank is 100K USD. It means in our bank we have a 100K fund. Accounts receivable, we have a 400K. Account receivable means we all know we have already sold some product on credit, so account receivable generate. Inventory 600K USD. They are our assets. They are already our asset. Our total current assets sum up 1.1 million. And our current liabilities, if we go to calculation of our current liability, our accounts payable is 300K USD. Our outstanding expenses is 100K outstanding. We have to pay it. So our total current liability stand up 400K USD. Actually, current asset is such an asset which is required to run the business. Our current asset was 1.1 million, but among the current asset, we already took up 400K as a liability. So if we minus this one from this one, then our net capital requirement is 700K. This is required now to run the whole show, to run our business. Now we are going to collect this 700K USD from the market. Okay, let's see how we can collect. Okay, we plan where could we collect our working capital. We can collect our working capital from bank. As we have some fund in bank, we'll take overdraft from the bank. We will collect short-term loan from the bank. We'll take trade credit. We will discounting feature. We also use bill discounting feature. Moreover, we have equity and as well as retained earning in our fund. So total working capital funding will check now. Whatever. Let's go through once again. From the bank overdraft, we will collect 200K USD. For 200K USD, we have to pay the bank 10% annually. So we have to incur 20K for this 200K USD loan. Okay, we can term this as revolving credit. So bank is taking only 20,000 for these 2 lakhs throughout the year. Okay, revolving credit means you have a credit limit, suppose 2 lakhs or 3 lakhs, you can roll it. You will take loan and deposit, take loan and deposit, and you have to pay the interest rate on daily basis, on monthly basis, or the time you use. If you use for 45 days, you have to pay the interest for 45 days. We'll go into more detail about revolving credit at the end of this lesson if we have time. Okay, just come on. Now we will also take a short-term loan from the banks. It might be for 6 to 12 months, 150K, and we have to pay 9% interest rate. It is almost 13,500 taka. You understand, hopefully. We will also take a trade credit. Trade credit, you know, we take some credit from the suppliers. We will not pay them instantly. We will tell them after 30 days you will get your payment. So we are getting also credit here, and as it is free, so we don't have to pay any interest rate or credit. Okay, our suppliers. We also take some discounting features. We know we have already have some receivables. We'll sell the receivables to the bank by 8%, 8% loss of our face value. Okay, as okay, you can go here. You just check what was our receivable 4 lakhs. Among the 4 lakhs, we'll sell 1 lakh to the bank at the expense of 8% loss of face value. Okay, we have to incur 8,000 here also. Okay, then what is happening? Total working capital is stand 41,500. Okay, 41,500. It is the working capital expenses or finance cost. It is the finance cost we are being charged, or we are about to be charged if we take this 700K credit from the market. Okay, so it is not a big sum. If we can use 700K throughout the year, we can run our businesses very smoothly. Okay, so we have to take it. No problem, we will take it. Now, what we see in our previous sheet, we are taking 700K loan from the market, and we are paying 41,500. Now we are calculating how much finance cost we are incurring now. Okay, okay, from our 700K due to bank overdraft purpose loan, we are taking bank overdraft 2 lakhs. It indicates 10% of our 700. Short term loan we are taking 150 divided by 7 lakh, it is 9%. Okay. And bill discount 1 lakh, 1 lakh divided by 7 lakh, 8% almost. Okay. From internal source, we are not taking, from internal source, we are taking 150K loan. And from trade credit, we are taking 100K loan. Okay. Already we have collected 7 lakhs. Due to the collection of these 7 lakhs, the interest we are paying bank overdraft for 10%, for 10% we are paying 2.86% throughout the year. Okay. 20,000. We are not taking 700K due to loan purpose. We are taking only 200K. Okay. So we don't have to pay the interest for 700K. We'll pay interest for 200K. And from short term loan, we are paying 150K. Sorry, we are taking 150K. We are taking 150K loan. It is almost 9% of our total loan taken. We have to pay 1.93% interest here, or we have to be a 1.93% year. Its value is almost 13,500. And from the bills discounting feature, we have to incur, you can see 1.14%. It amounts to 8,000. From internal source, as it is our internal source, don't have to pay any interest. And from trade credit, our creditors has also support us. They will not take any interest from us. So total finance cost will stand 41,500. Okay. Then these 2.86, this 1.93, 1.1400. If we sum all of them, our weighted average cost of capital will stand 5.93% all through the year. It is not a very big sum. We'll see in next sheet. If we go through the working capital finance cost ratio, you see, suppose in a particular year, if we can make a business of almost 5 million, you just think 5 million business we have already made, suppose in 2025. What was the finance cost? We have already calculated 41,500, right? 41,500 divided by 5 million into 100 is equal to 0.83%. This is the finance cost. You understand? Only 0.83%. It may happen. We may anticipate that from the business we will earn a gross margin. What will be the gross margin? Definitely 30%, 40%. Just from the 30%, we have to pay 0.83%. Okay. We are using others' money, not ours money. Our money is within us, and but we are using others' money and paying only 0.83%. It's very interesting. It's very interesting. We should always go for financing, external financing, rather than internal financing. It is very helpful for a business because our money is not going out. Rather, we are using others' money. Okay. Now let's come. If we calculate the finance cost on working capital, as we have take the others' money 700K and we are paying 41,000 and 1,500. We are paying only 5.93% on capitals. Okay. What does it mean? If we collect 700K from others, we build our asset. From that asset, we will pay them only 5.93%. And what will remain? It is almost 94% will remain to us. Ha ha ha. Very interesting. Very interesting. Very interesting. Okay, we'll go to some key insights. What we learned from here. Our current ratio, current asset minus current liability is equal to 2.75 to 1. It's very healthy. What was our quick ratio? As our current asset was almost 1.1 million and our liability is 600k minus 600k. Okay, we will divide it with the 400k. Okay, I think I will repeat it. Quick ratio is equal to current asset minus current liability divided by current liability. It is 1.25 is to 1. So our loan payment ratio is much higher. So we don't have to bother whether we could pay the finance cost or not. Weighted average cost of finances, we have already calculated 5.93% cost of capital. If we just pay 5.93%, we can use the fund and take it in my pocket. Okay. So definitely everybody will try to take others' money in my pocket. Will run the business with others' money, but at the end of the day, the money will be mine. So finance cost is well below 1% of total sales, it indicating a very efficient funding mix, and we will definitely follow this one. Hopefully, we all understand about the finance cost. It helps to understand the business easy. Actually, a business all the time require two types of loan. One is working capital loan, another one is long-term loan. Long-term loan is for long-term asset. Working capital loan is to a loan required to manage the day-to-day operation. So it's very clear. We have detailed if we start an operation, how we can start the operation and how we can sell very fine and nice. Okay. Hopefully, you have a very nice idea. You have understand everything. We'll discuss more in next some more in next sessions, some subsequent sessions. We'll learn finance cost more. This is our session one. Hopefully, you have enjoyed the session. Please stay tuned. No more today. More when we meet again. Up to this, thank you very much, everybody. Thank you.